If you received a confusing email from Social Security claiming you won't pay taxes on your benefits anymore, you're not alone. Millions of Americans got this message, and most people are completely misunderstanding what it actually means. In this video, I'll break down the real truth behind this big, beautiful bill, explain exactly who benefits and who doesn't, reveal why 90% of the claims are misleading, and show you what you need to do right now to protect your retirement income. Welcome to Financial Area, where we cut through the confusion to bring you the facts that matter for your financial future. If this kind of straight-talk financial analysis helps you, hit that like button and subscribe for more videos that protect your money. On July 3rd, something unprecedented happened. The Social Security Administration sent out an email to millions of Americans that was so unusual, so different from their typical communications, that many people thought it was a phishing scam. The subject line promised something that sounded almost too good to be true. Most Americans would no longer pay federal taxes on their Social Security benefits. The email praised what they called one big, beautiful bill, signed into law by President Trump on July 4th. They described it as a historic step that would finally remove federal taxes on Social Security benefits for nearly 90% of seniors. For people who have been struggling with the complexity of Social Security taxation for years, this sounded like a dream come true. But here's the first red flag. The tone was completely different from anything the SSA had ever sent before. Instead of the usual dry, bureaucratic language, this read like a campaign advertisement. It was so promotional that seasoned Social Security recipients, who have been warned for years to be cautious of suspicious emails, immediately became suspicious. They were right to be suspicious, not because it was a scam, but because the message was incredibly misleading. The email claimed that 90% of seniors would no longer pay taxes on their Social Security benefits. And while this number is technically accurate, it's also one of the most misleading statistics you'll hear about Social Security this year. Here's what actually happened. The law did not eliminate taxes on Social Security benefits, not even close. What it did was introduce a temporary tax deduction that might reduce or eliminate the tax for some people, but certainly not for the reasons most people think. The fundamental rules for taxing Social Security benefits haven't changed at all. The IRS still uses the same income thresholds that have been in place since the 1980s. If you're single and your income is above $25,000, or if you're married and your combined income is above $32,000, portions of your Social Security benefits can still be taxed. These thresholds haven't been adjusted for inflation in decades, which is why more and more people have been subject to taxes on their benefits over time. So what did change? Starting in 2025, seniors aged 65 or older can claim a new deduction on their federal taxes. It's $6,000 for individuals and $12,000 for couples filing jointly. But here's the catch that the email conveniently glossed over. This deduction only applies if your adjusted gross income is under certain thresholds. If you're single, your income has to be under $75,000. If you're married filing jointly, it has to be under $150,000. If your income exceeds these amounts, the deduction begins to phase out and disappears entirely once you hit $175,000 for individuals or $250,000 for couples. This is where the political messaging becomes really problematic. The SSA has traditionally been a neutral agency. They stick to facts, they avoid political language, and they certainly don't send out emails that sound like they were written by a campaign staff. This email was so unusual that it raised serious questions about whether the agency was being used for political purposes. Frank Bisignano, the commissioner of the SSA, stated in the email that the goal is to let retirees better enjoy the retirement they've earned. While this sentiment sounds nice, the way it was communicated was unprecedented and concerning fee, or an agency that's supposed to remain above politics. Now let's talk about who actually benefits from this change, because this is where the 90% claim becomes really misleading. Before this bill passed, more than 60% of seniors already didn't owe any taxes on their Social Security benefits. They were too low income to meet the thresholds I mentioned earlier. The new law increases that number to 88%. But the group that benefits most isn't the lowest income seniors. It's those in the middle and upper middle income brackets. Think about it this way. If you're a low income senior who was already paying no taxes on your Social Security benefits, This new law doesn't change anything for you. You're still paying no taxes. The deduction doesn't help you because you didn't need help in the first place. The people who benefit most are middle-income seniors, whose income was just high enough to trigger taxes on their Social Security benefits. For them, this $6,000 or $12,000 deduction might be enough to push their taxable income down below the threshold where Social Security becomes taxable. High-income seniors might see some benefit if their income is just above the old thresholds but below the phase-out limits for the new deduction. But if you're making $200,000 a year, this deduction isn't going to help you much. But here's who gets completely left out, and this is important. If you're receiving Social Security due to disability or as a survivor and you're under 65, you do not qualify for this deduction at all. The law specifically requires you to be 65 or older. So if you're 50 years old and receiving Social Security disability benefits, this law does absolutely nothing for you. Also left out are those with higher incomes above the phase-out thresholds. If your adjusted gross income is above $175,000 as an individual or $250,000 as a couple, you won't benefit from the deduction at all. And ironically, very low-income seniors, the ones who probably need the most help, were already exempt from taxes on their benefits, so the new law doesn't affect them either. This brings us to one of the most critical aspects of this new deduction that almost nobody is talking about. It's temporary. This deduction is set to expire at the end of 2028. Unless Congress acts to extend it, the deduction will disappear, and the old rules will snap back into full effect. This means that while the deduction may provide relief for a few years, it is not a permanent solution. Seniors and their families need to be aware that their tax situation could change again in just a few years. If you're planning your retirement finances around this deduction, you need to have a backup plan for 2029 and beyond. The temporary nature of this deduction is actually a common political strategy. It allows politicians to claim credit for helping seniors while keeping the long-term fiscal impact relatively small. But for the people who are actually affected, temporary relief can be almost worse than no relief at all because it creates uncertainty and makes long-term planning much more difficult. Now let's talk about something that might surprise you. This bill will actually make Social Security's financial problems slightly worse. Some of Social Security's funding comes from taxes on benefits. This rule was added back in 1983 to help shore up the program's finances during a previous crisis. By reducing the number of people who pay those taxes, even temporarily, the program loses a portion of its income. According to the Committee for a Responsible Federal Budget, this bill could move the projected insolvency date for Social Security from 2033 to 2032. While 1 year may not sound like much, when it comes to the future of retirement benefits for millions of Americans, every year counts. This creates a somewhat ironic situation. A bill that's supposed to help seniors by reducing their taxes actually makes it more likely that Social Security benefits will need to be cut in the future. It's the classic political problem of providing short-term benefits that create long-term costs. The politics behind this bill are pretty transparent. President Trump has long promised to eliminate taxes on Social Security, as well as on tips and overtime pay. This bill is a way to show progress on that promise, even if it doesn't fully eliminate the tax. For many older voters, this symbolic step is meaningful. It sends a message that their concerns are being heard. But the gap between the promise and the reality is significant. Completely eliminating taxes on Social Security benefits would be enormously expensive and would accelerate the program's insolvency by several years. This compromise allows politicians to claim they're helping seniors while keeping the fiscal impact manageable. So at Should You Do if you're receiving Social Security and want to know how this bill affects you. Start by looking at your income. Are you 65 or older? Is your adjusted gross income below $75,000 if you're single, or $150,000 if you're married, filing jointly? If you answer yes to both questions, you'll likely qualify for the new deduction, which could reduce your taxable income and lower your tax bill from 2025 through 2028. The deduction acts as a cushion on your total income, potentially reducing your tax bill and maybe even eliminating taxes on your Social Security benefits. If your income is higher than those thresholds, Or if you're under 65, the bill probably won't affect you. If you don't file taxes at all because your income is too low, there's nothing to change. But here's my strong recommendation. Consult a tax professional. Tax laws are complex, and individual situations vary dramatically. A qualified tax preparer can help you determine exactly how the new deduction will affect your taxes and help you plan for the future. If you prepare your own taxes, be on the lookout for this new deduction starting with your 2025 tax return. It will likely be a separate line item on your tax form, similar to other deductions you might already claim. The SSA's email was not a scam, but it did leave many people completely confused about what was actually happening. It promised something big, no more taxes on Social Security benefits, but the reality is much more modest. A temporary tax break for some people, not a full exemption for all. This episode highlights something really important about financial information. Headlines and political messaging often oversimplify complex issues, and the details matter enormously. When someone tells you that 90% of seniors won't pay taxes on Social Security anymore, that might be technically true, but it doesn't tell the whole story. The whole story is that most of those seniors weren't paying taxes anyway. The relief is temporary, and the people who benefit most are middle-income earners, not the lowest-income seniors who probably need the most help. Looking ahead, with elections always on the horizon and Social Security's long-term funding still uncertain, we can expect more proposals and changes in the coming years. Some will be genuinely helpful. Others may be more about politics than practical solutions. For now, seniors should stay informed, ask questions, and seek professional advice when needed. And the landscape of retirement income and taxation is always evolving, and staying up to date is the best way to protect your financial future. Here are the key takeaways you need to remember. The new law does not eliminate taxes on Social Security benefits. It introduces a temporary deduction for seniors 65 and older with moderate incomes. Most low-income seniors were already exempt from taxes on their benefits, so the new deduction primarily helps those in the middle and upper middle income brackets. The deduction is temporary, expiring at the end of 2028. After that, the old rules will return unless Congress acts. Social Security's finances will be slightly impacted, with the trust fund's projected insolvency date moving up by 1 year. The SSA's email was real, but its messaging was unusual and potentially confusing. Always verify official communications and read the details. And most importantly, consult a tax professional to understand how the new law affects your specific situation. The recent changes to Social Security taxation are a reminder that government policy is often more complicated than it first appears. While the new deduction will provide relief for many seniors, it is not a sweeping reform, nor is it permanent. As always, staying informed and seeking expert advice is the best way to navigate these changes and ensure you're making the most of your retirement income. If you found this breakdown helpful, make sure to like this video and subscribe to Financial Area for more honest analysis of financial news that actually affects your money. And remember, when it comes to Social Security and taxes, the story is far from over.